Have you wondered what financial advisors actually think about finances? This is your sneak peek at the conversations within Financial Design Studio. Michelle Smollenberger, the CEO here, will be your host as you go behind the designs.
Welcome back to the Behind the Designs podcast. Today we are going to be talking about investing across your lifetime. You hear people say you should start early and save often, but how and where do you start? You want your investments to grow, but you also may be worried about what you see in the world, so it just doesn't seem like a great investment landscape. So how are people succeeding when it comes to their investments? These are the types of things we're going to talk about today, and this doesn't necessarily mean you're a baby investor. You could have money saved, and now you're asking the question, how do I invest this? Or how do I pay attention to this? So we figured to answer this question, there's no better person to talk to about this than Rob, who is our Chief Investment Officer. Welcome, Rob.
Awesome to be back. It's great.
We're pulling you out of the investment world. Stop looking at the screen for a few minutes.
Yeah.
And we're going to talk about this. So this is really the world that you live in, is investments.
Yeah, and it's a great topic because it's whatever you do in life, you kind of become really well versed in that, but then you realize not a lot of people outside your circle really understand it. So it's great to just kind of pull back and let's talk about this logically and in plain English.
Mm-hmm. Sometimes, like this is actually where kind of like the Behind the Designs podcast name came from, because we have all these conversations internally. So here as a team, and even yesterday you were updating us on the market and kind of the Fed had just talked or inflation came out.
Yep.
And so Rob was basically like, so to put this in terms that Trevor, who likes racing and cars on our team, you kind of put it like in his terms, and you were like, oh, let me just describe this with this analogy.
Right.
And so it was so funny. So it's really, that's what we're trying to do, is to kind of put this into terms that you understand.
Yep.
But also, understand what you're doing so that now you have clarity to invest with confidence.
And make it practical. Yeah.
Exactly. Yep. So that's what we are going to dig into today. And really what we're talking about is investing for your lifetime. So if we just start with, we have money to invest, how do we do it? We're going to cover, what are my investment options? We're going to talk about, how do I even determine what the right investment mix is for myself? And then we're going to touch on a future episode on target date funds. So there's a lot of different ways that you can answer this question. And so I guess if we just even, how do we even talk about this? How do we even think about it? What are some challenges? There's some ways that you see people kind of approaching this.
Yeah. So the biggest challenge I always see is, you watch TV commercials, they're always telling you save, which is great advice. You should do that. But there's so little, in my mind, information about how to do that and how to do it effectively that isn't necessarily in the self-interest of whomever is trying to sell you an investment product. So, it's the person who says, I have money, I want to invest, I just don't know how. Or if they decide, okay, I'm going to go invest, you open up an account at Vanguard or Schwab or somewhere, and you realize there are thousands and thousands of different funds and stocks and bonds that you can buy. And it's like, well, where do I even begin? And then, as I just mentioned, the financial industry is filled with just a lot of people who are salespeople. And, no knock against them. We all got to make a living. But too often, products are sold to people, investment products that, frankly, aren't very good for them, or they're just really expensive. So, So, there's just a lot of different, as we kind of talk about this, a lot of different challenges that people face when they go into this.
Yeah, and I think even some people are probably kind of like this fear of, what if I make the wrong choice? And I think sometimes too, people, you can make a mistake, you choose the wrong investment, and then it's almost like you double down and try to fix that, and so you can just spiral into making bad choices, I think, if you're kind of going it alone.
Yeah, it's like going to a restaurant. You don't know if it's going to be good or not if it's your first time. If it's not good, it's like, oh, that stunk, $50 out the door. But when it comes to money and investing, there's just this feeling of permanence where it's like, if I make a mistake with this, I'm going to be I'm going to have to live with that mistake for years. So we actually have found a lot of people have come to us that have had their 401ks in cash or accounts in cash because they just didn't know what to do with that. And that's really what we're trying to address here today.
Yeah, exactly. And then you kind of have the tactic where people just avoid. So I just won't look at my statements, and maybe that will make it look better. So I've saved. Maybe I set up those funds that you talked about, kind of set up that account. They're just in, maybe index funds, whatever they're in. If I just don't look at my statements, maybe when I look back at them, they'll grow. The only problem with that is over the last few years, the market has gone up, down, up, all over. And so now that they're looking at those statements, they're saying, well, wait, it hasn't changed. You're right. It hasn't changed because the market has essentially gone sideways. However, there are reasons for that. And so this is where we're going to answer all these questions of, so what should I be thinking of? How do I think about this well? And so, it's just things like that where, okay, none of those tactics. Now we're going to do something different.
Yep.
So
exactly. Yep.
Now you wrote an article about this called Diversification Isn't Dead. So talking about, now diversification is a big word. And so on this episode, we're going to break down some of these words. So when we talk about being diversified, that's just very simply not having everything in one basket. We want to have some in different baskets. So just big words, I think they get used a lot.
Yep.
So you wrote an article about this and why it still matters. And we had a client event maybe 5 years ago now where we were talking about, let's see how the S&P 500 has done. And we kind of said, you had this at over the last year, over the last 5, 20. Describe, when people look over the last those number of years and they look at just the S&P 500 versus a portfolio that has a variety of things. Describe what you found when you were kind of putting those slides together.
Yeah. So it's investing successfully. You really do have to kind of be a historian almost and really look at just the long term because we always get focused just because it's the news flow on what's happening today. Yeah. So many investment thoughts and opinions get formed on whatever the market is doing right now. So if it's up, people are bullish. If it's down, people are bearish. But also when it comes to investing in diversification, even what happens is you go through periods like we're going through right now, and frankly for the last decade, where a certain part of the U.S. stock market is doing really, really well, and the rest of the market is it's there, but it's lagging behind. So it just kind of leads to this belief that, that's all those other parts of the market I should just completely avoid. But when you pull back and look at history, and one of the things we talked about at this client event was the S&P 500. So right now it's very concentrated. There's a small number of stocks driving it. Exact same scenario we saw in the late 90s. And what happened was after the tech bubble burst in 2000, the S&P 500 went nowhere for a decade. And but other parts of the market did. So small company stocks, mid-sized company stocks, value stocks, kind of the older like banks and energy companies, things like that. So diversification, that's why it's really important to really understand everything we're going to talk about because it's not just just pick this one or two funds and you're done kind of thing.
Yeah, exactly. Because every fund, so even when we talk about what a fund is, I'm choosing a basket of stocks, so a basket of companies, basically, or a basket of bonds. I'm choosing that fund. It has a strategy, and so it's investing in those companies to do a certain thing. So it might be trying to get the most out of U.S. stocks or, the best out of bonds. So each of those have a strategy. So if you're only doing that, then like you just said, if the rest of the market is going nowhere, or if it is going somewhere and you're not in it, then that's what can create a problem.
Yep.
So.
Yeah, exactly.
No, that's really helpful. Okay, so now we know, we can't just do nothing. So we can't just not look at our statements, avoid it. That's not going to work. That will cost you. So, even when we talk about why we invest, we have to keep up with things like inflation and, interest. I think typically when people are afraid, what do you feel like they typically tend to do? Like when they don't know what to do, they may just leave their money in a bank account, or they just
Oh, yeah, yeah. I mean, you think about anything in life, if you don't have a lot of confidence in doing something, the default choice is to do nothing because I can live with doing nothing. I have a harder time living with doing something and then, turns out I made a dumb decision. So the default for a lot of people is not just in investing, but in any aspect of life is I'm just not going to do anything. And it's with investing, the problem with doing nothing is we have this thing called compound interest, what I think Einstein called the eighth wonder of the world. And each year that you kind of delay doing something, that is a year of potential market earnings that you're losing. And that just compounds over time. So you see it all the time with articles yelling at 20-year-olds to start saving for retirement today, because if you wait until age 40 to start, you're going to be behind the eight ball, which is true. But again, it's that dynamic of, well, I don't really know what to do. My default is I'm going to do nothing. And so that's really what we're trying to kind of deal with today.
Yeah, no, I think that's perfectly said. And it's surprising how many people, even new clients will come to us and they might have a few $100,000 sitting in a bank account earning interest. Now, that might have worked over the last year or two because interest rates have been good.
Yeah.
But again, that's our whole point today is that it doesn't, one thing doesn't work forever. And so we're really talking about how we invest across our lifetime, and that changes.
Yeah.
All right. So then it's kind of, okay, so how do I go forth and invest?
Go forth, young man, right?
Exactly. So talk us through kind of what are some of our options? So if we know what we can't do, what we shouldn't do, what are some investment options that we have?
Yeah. So it's good to just kind of know what's out there because, I mean, there are literally limitless ways to invest. The most popular that we see all the time are obviously stocks. People generally know what those are. You own shares in a company, it grows over time, and you get to participate in that because you are a part owner in that company. But you have stocks, you have bonds, you have cash. I mean, that is actually an asset class. It really wasn't an asset class for the last dozen years because interest rates were zero, but now you can earn 5% on cash. So that's a real asset class. But beyond that, I mean, you can get into annuities. That's a way to invest. You can get into real estate. That's a way to invest. There are alternative investment funds where you kind of give them your money. You can't get it out for 5 or 7 years, and they promise you a return, something illiquid. That's a way to invest as well. But, I mean, literally, there are so many different ways to invest.
Yeah. And I think what's so interesting is all of these different ways. So something you mentioned was asset classes, which is simply just a group of, so stocks, bonds, those are different. And so we call them asset classes just because they have different characteristics. And so each of those asset classes are necessary or important potentially at different times and for different people in different circumstances. So I think that's what's so interesting is even just people knowing there's so many different things you can invest in. And I think that might be where it becomes so overwhelming, where it's like, great, I could choose from anything. I don't even know where to start. So that's really helpful to even break down all the types of things we're choosing from.
Oh, yeah.
All right. So we talked about the word diversification. Another way that I think advisors or investment people talk about this is asset allocation. And again, when I'm saying these big words, they're actually like very simple. We're just saying we're going to allocate a different part of your investment bucket. So all of these funds you have to invest, we want to invest one portion this way, one portion this way, another portion this way. So we're just saying we're going to allocate it over different types of investments so that we're accomplishing different things with those groups. But collectively, you're getting a custom strategy for you. So
exactly.
Customizing what you need. Okay.
Yeah.
So I guess describe, because this is exactly how we like to invest. So Rob, describe like what we like, how we like to describe that here, or say what that is.
Yeah. So I really dislike financial jargon, and asset allocation falls under that. It's like most people gloss over. It's like, well, what does that mean? So I always like to use analogies to just kind of help all of us think about it. And the way to really think about asset allocation is almost like all the advice we hear about eating a well-balanced diet. It's like when you have a plate, a third of it should be protein, a third of it should be vegetables, and a third of it should be carbohydrates or starches or whatever it is. So it's all the advice is if you're doing that, you have a good mix. Each of those areas does something for you, but you get the most benefit when you're doing all of them at the same time. So that's really what asset allocation is all about. When we talk about asset allocation here at FDS, we like to keep things simple. So we're focused on stocks, bonds, and cash. And each of those areas will do something for our clients. The stocks are there to help them grow and kind of outpace inflation. The bonds are there to generate income, also keep pace with inflation, but provide more stability. And then you have cash that especially for retired people, that is something that they're living on. So you need to kind of allocate towards that bucket as well. But when we're really talking about asset allocation, that's what it is. It's having that well-balanced diet of some growth stuff, some income stuff, and some capital preservation stuff.
I think that's the perfect way to say this and say that, like that analogy. And this is a perfect comeback to that. Rob, I've heard you should have 25%, like a quarter of your plate should be in protein, a quarter in carbs, and the other half in fruits and vegetables. That's like the perfect analogy of you saying a third, a third, a third. I'm saying a fourth, a fourth, a fourth.
Yep.
It can be different for every person. It can be different for how. So I think that's the perfect way to set it up. That's exactly what we're talking about is your allocation in your plate. How are you applying it on your investment strategy?
Yeah, I mean, there's so many people give different advice about that. We are going to touch on that in just a moment of like, how do you figure out how much to put, what percentage to put in this part of the plate versus that part of the plate. So
exactly. All right. So let's dig in. All right. So really, now we're jumping into like, how do I determine the right mix for what I should own between my investments? So let's just why don't you just run through, here's factors that we look at that we want to, when we're trying to decide this, what matters.
Yeah. So there are a variety of factors we look at. Some of this is frankly driven by compliance. So the government says when we bring on a new client, we have to assess their situation. And when we make an investment recommendation, it has to be suitable for that client. So that is part of our fiduciary duty to clients. The way we kind of approach that is we look at, we try to look at the client's life from a number of different ways to figure out, okay, where are they in life? So some of the things we'll look at, employment status. What does that mean? Is there one person working, or if it's a married couple, are both working? Because depending on if it's one person working or two, that might determine or influence how aggressive they can be with investing. Income stability. If you have a stable income, you know what you're getting week after week, you've been at that job for a long time, you could probably maybe take a little bit more investment risk because you have a little more certainty about what your income is. If you're a real estate agent or you're in sales and your income is like all over the map year to year, and when things are bad, you're having to kind of live off of savings a little bit, it's like, okay, that's a different investment approach right there. Liquidity needs. This will kind of get into something we'll talk about time horizon in a bit, but are you somebody who's currently retired? If you're living off of your savings, that is a factor we need to talk about and think about, because you probably don't want to gamble that in the stock market, have it go down, and then you can't buy your groceries next month. And then, the last two last one is really around risk tolerance. This is a little bit harder to assess with people. There are surveys out there. I have personally found there's not a lot of value in those, because if you ask somebody what their investment tolerance is in a bull market, they're like gung-ho, let's go all in. If you give them that exact same survey when the market's down 20%, they're going to be like, get me the heck out of this thing, this stinks. So, but that is just something as part of our process of getting to know our clients, new clients, we get clues about that. So if there's a lot of cash in savings, that could be a clue that this person is more risk averse than somebody who is diligently putting all their extra cash in the stock market.
No, that's a really helpful kind of just overview of here's the different factors. And you're right, some of those factors stay the same. So, if you have a stable job that you've been there for 20 years, you're probably going to be there for 10 more, things still look good. Some of these factors don't really change a lot, but some of them do. And so I think time horizon is really a good one to spend a lot of time on, because this is where it's different for everyone. And I think even once you start looking at your financial plan, you might start realizing, oh, well, I thought I was going to work until age 67, but actually I could work just until age 63 or 65. So even that time horizon, just now with what you're learning about your finances, can change. So that's helpful.
Yep. Yeah. And that is really the big one, because in our industry, a lot of financial advisors, a lot of financial people, they center the conversation around time horizon in terms of when are you going to retire. And that is certainly a goalpost or a marker to look at, but that is only part of the story when we're talking about time horizon.
Yeah, and I wonder if the reason for that is that most people, when you're investing, so we've talked about starting out, you kind of add money in, you choose some funds, and really all you're trying to do while you're working is grow those funds. You're not planning to use them because you're working, so your employment income is going to support your lifestyle. So you're just trying to grow all of these assets, all of these funds, but now when you start to get close to retirement, it's like, wait, now I need to start using this money. And so I should probably think a little bit more about my investments that I own. And I think that's why that kind of tends to be maybe one big area where people start to think, oh, okay, wait, I'm going to need this money someday. I can't just keep doing what I've been doing because I don't really know what I've been doing. Yeah. So I think that's probably why, probably one of the big reasons. So kind of talk us through, I guess, this first, the big question that we think of when we're choosing the investment strategy as far as it has, with time horizon, what's kind of what we think about?
Yeah. So time horizon, of all the factors I kind of talked about before, this is really the one that at the end of the day governs how you should invest. So the key question you want to ask when you're thinking about what is my time horizon for investing is, when are you actually going to need or use this money? And because that really guides how you should invest. So, we could take a great example would be a mid-30s married couple. They're starting to have young kids. They've just moved out to the burbs. They can have multiple time horizons. So for retirement, their time horizon is very long. They've got another 20 or 30 years of work ahead of them. Save and invest, be aggressive with your investments, and let that play out. But then maybe they're looking to buy a home next year and they need a down payment for that and they have cash. Well, you definitely want to invest that differently than you are for retirement. And then if you have kids and you're saving for college, it's that's, if they're young, I have a long time horizon, but not 20 or 30 years. It might be 10 or something like that. So that really, at the end of the day, your time horizon really guides how you should be investing. And the key here is you can have multiple time horizons. It's not just one and done.
Yeah, and I think that's one of the other questions is kind of what are you saving for? It's the same question. It's really, what do I need to use this money for? And like you said, so it's even within all of this money that I have to invest, there's even different buckets of, well, this money is for this is for this, and so wait, I need to have different strategies for each of those buckets.
Yep.
So no, that's really helpful. So I guess when we think about that, are there different levels? Is there big picture, this is kind of what you want to own? Kind of talk through how you would break that out.
Yeah. So the way to think about it, again, here at FDS, I like to just keep things simple with investing. I've been in this industry way too long. I have seen so many financial products come and go, and when you boil it all down and you just look at it, it's if you just invest in a simple mix of stocks, bonds, and cash, low-cost investments, you're going to do really well. So that's what we focus on. We don't get into a lot of esoteric, non-traded REITs, these real estate trusts that are out there, whatever other products are out there. So we'll really focus on stocks, bonds, and cash to a lesser extent because we all know what that is. But if you look at stocks, what the purpose of having stocks in your portfolio is to give you growth above the rate of inflation. So we can go back 100 years. There's a lot of data on stock market returns over the long term. And if you look at stocks over the last 100 or so years, they have returned around 9.5% on average each year. That's absolute, or what they call nominal. I don't want to use a lot of jargon, but that means like after inflation, like 9.5%. I put $100 in at the end of this year, I would expect $109.50.
Okay.
Inflation tends to average about 3%. So again, I'll use a little bit of jargon here, but stay with me. When we talk about inflation-adjusted returns, we call that real returns.
Okay.
So if we kind of take that 3% out of that 9.5%, basically what that is saying is out of stocks, you're getting 6.5% growth above the rate of inflation.
Okay.
The purpose of having stocks is to do that. You want growth because the more your investments grow, the less you technically have to save today to meet your future goals. When we get into bonds, the long-term average there is 4.7% in terms of total returns. You take 3 out for that. For inflation, you're getting real returns of 1.7%. So that is a lot less, but the purpose of having bonds in your portfolio is to generate income. So as you're maybe near a goal, whether it's sending a kid to college, they're in high school and you're getting ready for that, or you're in retirement, you want to have income and more stable investments so that you know the money is going to be there when you need it.
Yes.
And then you have cash, which if you look just over the very long term, the best you're ever going to do is basically the rate of inflation. So if you stuck your money in a mattress, you're going to lose 3% a year for inflation. If you put it in a bank account, maybe you'll keep up a little bit. But the cash is really there just to meet your most immediate needs.
Yeah. And even when we talk about cash, one of the hard things is you can invest in cash in different ways. You know, there's your bank account, just a savings account, where it's like right now is still 0.001%.
Yeah.
When interest rates are at 3-4% in a high yield money market, just a money market account. Again, it's just two forms of cash earning very different rates. And so it's just paying attention to where your money is.
Yeah.
So that's really helpful. So we kind of have like this big umbrella. So we have maybe like stocks, bonds, cash. I guess within that, am I just buying like, okay, if I say I have 70% in stocks, am I just putting it all into one type of stock? Are there different types of stocks? Kind of just describe how you think about kind of under even that.
Yeah. So, I mean, there are a lot of different ways underneath those broad buckets of like stocks, bonds, and as you just said, cash. So you go to a restaurant, you order dessert, it's like, I want pie. And the waiter says, we have blueberry pie, we have apple pie, we have peach cobbler. I mean, you know, you have to make a choice. It's not just, I want pie. You have to actually say what kind of pie you want. It's the same thing with stocks. There's U.S. stocks, big companies like Apple and Microsoft. There's small company stocks you've probably never heard of, but they're out there and they have stocks on the stock market. There's emerging market stocks. There's international stocks like out of Europe and Canada and more developed economies. So there's a lot of different ways. There's a lot of things on the stocks menu. And same thing with bonds. You have U.S. government bonds. You have corporate bonds, which would be, again, like Apple and Microsoft. They have bonds out there. But you also have what's known as junk bonds, which are very risky companies, but they pay really high interest rates to kind of account for that risk. So there is a lot going on underneath those big headings for sure. And, you know, getting back to diversification, what we're always trying to do, all those different areas will perform differently over periods of time. So what we're trying to do is just make sure we have a good mix between everything that's available, or most everything under stocks and bonds. And so that what you get with a good diversified portfolio is you get what you're trying to achieve. You get growth out of stocks, you get income out of bonds, but you're getting it in a way that is maybe a little less volatile than it would be if you only invested, you know, you take somebody who owns like only one stock. It's like their entire fortune rests on the fortunes of that one company. So we really try to diversify that.
Yeah. Yeah. And that's where even, we talk about all these different factors that investors have. Someone who, a lot of our clients have executive compensation. So we talk about like those are benefits that they're getting above salary or bonuses, but their company has said, hey, here's, a stock option or restricted stock. So we're going to give you company stock. And so that's a concentrated, okay, here's an amount just in that one stock. So how do I even fit that into then my whole, again, this big picture of if here's where I want to be, 70% in stocks, 30% in bonds. And that's just, we're just using that as an example.
Yep.
But how do I even fit pieces like that into it? And so it's all of that where this is what you need to keep in mind so that your money is there when you need it, really, for whatever that goal is.
Yeah. Yep.
That's helpful.
Yeah.
All right. And I think one thing, too, that sometimes I think this is where people can also get overwhelmed is, we all talk to our friends. We talk around the water cooler at work or on Zoom rooms now. May not be as much around the water cooler.
Right.
But, we talk to friends or we hear, oh, I'm invested in this. My account's up double digits. And I just always want to remind people that people tell you the good parts of the stories. They don't always tell you the whole story of, that one stock was up, but everything else was down double digits too,
Yeah.
So it's just keep in mind, as people tell you things and as you're comparing yourself, unless you're sitting down with their statement and your statement, the same time that you're talking about, over the last year, over the last week, just keep in mind and be careful to not compare yourselves to other people, but just ask questions of, okay, if I think this is true, just dig in and kind of research and see why.
Yep.
Or
Yeah.
if it really is the case.
Yeah. Yeah. If there's one thing I've learned in finance during my career, it's the more exciting it is, the more dangerous it tends to be.
Yeah.
Boring really is beautiful sometimes, and I think that's certainly the case with investing, because time and time again I've seen investment products pushed on people that promise big returns and you'll get your money out and blah blah blah, and then we go through a crisis and the money is gone or something happened. And we saw that happen a lot about 15 years ago during the financial crisis. So, it really is, you really do have to kind of check yourself a little bit and say, am I okay? Boring is beautiful. Am I okay with that? Or do I need a little extra sauce or sizzle in what I'm trying to do?
Exactly. And when we look at these factors, it might be that someone is just, maybe halfway through they've said, oh, okay, I have my kids' college set aside, but now I need to focus on retirement. They might be in their mid 40s, early 50s, just starting this. And so again, that is going to be different. So they may be trying to catch up or, so there's different factors besides just, it isn't just whatever I need has to come from investment growth.
Yeah.
There's so many different things outside of how your investments are growing. How much am I saving? What am I spending? And so much of this comes into shape, here's how I should invest.
Yeah.
So.
Yep. Yeah. And I mean, just to make sure we're kind of doing the circle and everything. So with time horizon, that really is the longer your time horizon. And what we mean by that is the longer it is before you'll actually need to use the cash. The more, generally speaking, the more aggressive you can invest. So having more stocks, less bonds, not a lot of cash is usually the best way. So you kind of think of somebody in their 20s, 30s, maybe early 40s. This is not investment advice, but it's okay to invest aggressively because you have a lot of time before you're going to retire and use that money. If you have a child in college and they're in high school, guess what? You're going to be using those savings, whether it's in a 529 or some other account, you're going to be using that money very soon. So you don't want to invest that aggressively. So you want to have a lot more bonds, less stocks, because that time is coming up. So it really, thinking about time horizon, you have to really put a little bit more thought in it than what age am I or when am I looking to retire. I was actually just looking at this yesterday for my wife and I. I found a website that will actually tell you how long you are going to live based on your age today, your health, do you smoke or not. And I was actually shocked to find out that either my wife, Glenda, or I, there's a 70% chance that one of us will be alive will make it to age 90,
Yeah.
which is great, but if you kind of think what happens a lot is especially for people nearing retirement, the industry always says you want to de-risk, you want to, you're going to start using your money. All of that is true, but you will, even if you make it, if you're at age 65, you might have a 20, 25, 30-year time horizon ahead of you. And if you do, you want to make sure you're not invested so conservatively that you're not or just barely keeping up with inflation. You do want to get some growth out of your investments. Maybe not like when you were 25 and it's like, 80 or 90% stocks, let's do it. But, having 50, 60% in stocks, even when you're retired, even with the volatility, it might not be a bad idea just because you still have a very long time horizon.
Yeah, I think that's a really helpful point because I think people can get nervous putting that much in stocks, even if it's only 60% when they're retiring. But one thing I know that you'll tell people is, do you need all of that money on day one of retirement? No, you don't. You need it for those 25 or 30 years. And so it's making sure that as you get closer to when you need that money, then you can start to get more conservative so that the money's there when you know you're going to need it. But at the same time, it's not overdoing it, so you still get that growth you need.
Yeah. I mean, the volatility in the markets is a reality. So that 9.5% average I talked about, it never goes up 9.5% in a given year. It's either up like 15 or it's up 5 or it's down 15. It can vary a lot. So we have conversations with our clients who are in retirement. We have regular conversations. How much cash do you think you're going to need this year? And so we try to kind of set aside that cash ahead of time so they know it's there, so that we know it's there. And if the market is going through a bad period, like a couple years ago or during COVID where stocks went down a lot, from a practical standpoint, what we're doing is we're looking at that client's asset allocation. We're saying you should have 60% stocks, 40% bonds, for example. And the market's down a lot, so you're actually at 55% stocks and like 45% bonds right now. So when they need cash, what we're doing is we're actually pulling money, we're freeing up cash from what has actually done well or what has proven more stable. So we're not selling stocks at the bottom to raise this cash to live on. We would be selling bonds in this case, freeing up some cash, bonds have held in, and so that they can keep money in stocks for that eventual turn after a bad year. Historically, markets will bounce back, and we want to make sure that our clients are in there doing that. So,
yeah. And I love just that your process for that. It's like you'll always say, it's kind of forcing that buy low, sell high. So that's what you're doing.
Yep.
And when you're working, like when we're working with clients and we know when they're going to need it and we're communicating regularly, now we can plan for that. So now even if the market goes down, we've set aside those funds into a safe place. So into something like bonds so that even if the market goes down, the money's there for them.
Yeah.
So just being prepared, and I think, it just really kind of helps to remind people, like, this is why you would want to work with a guide who, really that's what we do is guide our clients into what they should have for them. And so it's going through these factors, just like, someone starting out saying, how do I do this? This is kind of how we walk through that process.
Yeah. And as I mentioned before, over the course of your life, you're going to go through all these different time horizons. You're going to go long. I have retirement goals. I want to buy a house. I want to send kids through college. There's a lot of different time horizons that one person or a couple will have at any given point in their life. And, again, age does not define that. It's really the individual circumstances. So that's why anytime we make a recommendation, that investment recommendation is really tailored for that particular person. We don't just say, you're 60 years old, we're going to pigeonhole you in this strategy. It is really individual, it's tailored, and because at the end of the day, we want you to be successful. And if you're not comfortable with how what we're recommending or how we're investing you, and the market goes down, which it will at some point, the last thing we want you to do is to say, well, I wasn't really confident in this thing, so I just want to get out and leave. We want you to really know and understand everything up front so that when we do go through those cycles, which you will, you have understood the whole time what we're doing. Here's the plan. Here's what can happen. And so when you go through those cycles, you stick to the plan, and eventually, based on history, things will work out just fine.
Yeah. One of the things I like as you're writing, I know you write a lot of blog posts kind of trying to explain what's going on. And I think it's so helpful when you kind of point us back to history, because so much changes, but so much does stay the same. And so this is where sometimes even just working with someone to help you, just, sometimes I think we're just helping people stay invested, because otherwise if you're on your own, you would change. You would do something, that may not be good for you. So I think all of that just helps to understand and put perspective into why you're doing what you're doing.
Yep.
That's good.
Yeah.
Well, thanks for explaining all of this. I know it's kind of like it's kind of like this top down, like this big picture, and breaking it into smaller pictures, and how do I even do this? So thanks for explaining kind of how you view this, and how I know this will help people as they think about, if they're just starting, how I should invest.
Yeah.
Any kind of final encouragement you would give people?
I mean, I don't want this to be a shameless plug, but I mean, this is what we do for a living. And I think there's points in life, there are important things in life where it's okay to say, you know what, I need help from someone, an expert or whomever, to kind of do this. I've talked about it on the podcast before. I'm working with a personal trainer. I know nothing about muscle groups or, work on your arms and abs this day and legs, whatever. It's like, I don't understand all that. So I need a guide to do that. Yep. Or, we're coming up on spring here in Chicago, and you're seeing all the guides come out. It's from like Scott's Seed and Fertilizer. It's like, you do this seed in March, you do this fertilizer in June, you do this. And it's just like, it's just overwhelming. And, at least for me, I've been like, I just will pay somebody to do that. They know what they're doing. They're going to get it done. And, that is what we do for people, is we help them just get it done. We monitor it all the time. We'll make changes. And when life happens and something unexpected happens, whether it's an inheritance or, we have another kid on the way, whatever it is, I mean, we are there to adjust that plan and course correct where it needs to happen. So, it's again, that's just my personal view is it's okay to say, I'm going to pay somebody to help me to do this. Yeah,
exactly. No, and I think that's probably like the big message from today is just take action, do something. You really can't do nothing. Like, that's not really an option, because it just won't keep up with inflation. It just won't help you reach your goals. So if you know you need help, just like you mentioned, Rob, reach out. This is what we do. So in our next episode, we are going to talk about target date funds. I know you're going to be back, Rob. So thank you so much for explaining all of these investment pieces to us. We're going to talk about the pros and cons and how it might fit into your asset allocation strategy, just like we've talked about today. We release new episodes every 2 weeks, so be sure to subscribe so you don't miss out. And if you have any questions, you can send those to podcast@financialdesignstudio.com. And we will see you on the next episode. Thanks for listening.
Thanks for listening. To find any links or resources related to this episode, check out our show notes. Your host was Michelle Smallenberger, a certified financial planner and CEO. The guests featured are from Financial Design Studio, a team of experienced, fiduciary, fee-only advisors based in Chicago. Anna Lewis is the executive producer of the Behind the Designs podcast. And as always, for more information about Financial Design Studio and who we are, check out our website, financialdesignstudio.com. And final note, no content discussed on this podcast should be taken as financial advice. Financial Design Studio accepts no responsibility for your individual choices. We'll see you in the next episode.